A very busy week on the Nigerian business and markets, which comes to an end today with the banking names grabbing the headlines alongside the oil stocks and others, even as the yields continue to tumble at the central bank primary market auction ahead of September 24 interest rate decision. And there is more to chat to in the week. So let's bring on Johnson Chukwu, a market professional and the group CEO at Carry Asset Management. Hope you had a profitable week so far. Good evening.
Good evening, Boston. Thank you for having me. I think the market performance this week were quite positive. So any player in the market would have had some level of excitement, given that the market gained about 0.44% this week.
You're smiling all over. The smile tells it all. I just need to read your lips. It's a profitable week. But again, it's a whole lot to talk about. But let's chat to this ₦1 trillion profit report by GTCO. Walk me through that number.
Well, Boston, I think if you look at the GTCO's half-year results, where they made a profit before tax of about 1 trillion naira, and the profit after tax of about 902 billion naira, and earnings per share about 32 naira per share. And if you look at those three major revenue heads, you look at profit before tax, you look at profit after tax, and then you look at earnings per share, they all increased by over 200%. Well, as if you look at the operating cost of about 201 billion, it increased by only 60%. What that means that GT Bank has actually shown a higher level of efficiency in terms of revenue generation. And it has kept its costs low and been able to grow revenue by more than 200%, while costs grew by only 60%. And that can explain why you see a profit jump to about 1 trillion naira before tax in half year, and the profit after tax about over 900 billion naira in half year.
One of the, I'm sure you could, if you look at the screen, the earnings per share was a very strong 223%. Profit after tax was at 222.6%. Those are triple-digit growth in just 6 months of this year. Give me an idea what GTCO is doing much better than the others, perhaps.
Well, I think one of the things they are doing is that they are getting a lot of income from their non-fund-based activities. If you look at GTCO, they are known to be very conservative when it comes to loan growth. So basically, they are actually extracting a lot of value from their fees and commissions activities, which means they are growing their service levels and improving service level benefits to customers, and therefore extracting value from those services. So you see their commissions and fees grow materially, you see their trading income grow materially, while the bank has always remained a conservative bank when it comes to risk asset creation. So GTCO is known to have a conservative risk asset profile or structure, while as it's growing its commissions and fees. And I think a lot of the growth we saw came from commissions and fees.
So how would you trade the news? How would you trade these earnings? How would you, the GTCO just concluded its offer, by the way. So how would you trade?
Well, interestingly, we don't have the result of the offer, and I wish that the investors saw this result before the offer closed. I'm sure they would have been, I feel there would have been a scramble for those shares that the GTCO offered. But I think what has happened is that the market has traded in the front of GTCO and expecting that other banks, particularly the tier 1 banks, will also follow suit. If you look at the market performance this week, of the 5 days of trading, the market gained 3 days. It gained on Tuesday, gained on Thursday, and gained on Friday. And the market gained 0.91% this week, contrary to the loss of about 0.15% it recorded last week. So it then means that the market had begun to price in such impressive performance that GTCO reported, and expecting banks like Zenith Bank, UBA, Access Bank to also come up with mouth-watering performances. And investors, if you understand investors, they know the likes of GTCO are known to pay interim dividend. So with the result as mouth-watering as 901 billion, I think 901 or 106 billion in half year, it's expected that they will pay interim dividend to investors. So investors are beginning to position in preparation for such benefit payment, mid-year benefit payment from banks that are recording such impressive results.
So of course, that's a #1 per share cash dividend that GTCO just announced on those earnings. Well, let's go back a few days before the earnings from GTCO, where the FBN Holdings spinned off this merchant banking subsidiary. How much of the backstory to this transaction do we know? What value does that sale of FBN merchant bank, does it bring to the shareholders and to the bank itself?
Well, interestingly, that information was not made known to the public, or I'm not aware of the consideration that was paid to FBN Holding for the sale of FBN Quest. But one thing I would take away from that is that the investment bank, the merchant banking space in Nigeria is challenged. We have the likes of Nova converting to commercial banks. So you realize that the banks who had got license as merchant banks would rather prefer to convert to retail banking or commercial banking. And that has repeated the history of the Nigerian banking system. We saw that happen when they introduced the universal banking system.
Yes.
We've seen a number of merchant banks convert to commercial banks because of the large ticket nature of the deposits of merchant bank, which restrict their coverage or restrict their customer base to only high HNI, high net worth individuals. So I think what First Bank did, or First Bank Holding did, is to look at identify where they have their niche market.
Yes.
FBN Holding still remain one of the largest commercial banks in the country, and they felt they want to focus on their primary commercial banking business. Yes. And spin off the merchant banking business.
Well, I thought the merchant banking business had actually come to a complete end. I'm sure you remember 2004, 2005, banking sector consolidation. Nearly all the merchant banks went down in Nigeria, with just perhaps a few exceptions. I think FBN Merchant Bank was one of those that survived that exercise some 20 years ago. And now the FBN Holdings is spinning it off. We don't have the naira value of what that transaction is, like you said, the consideration. But what do you think really mean for FBN Holdings? The company is looking to recapitalize as well. Do you think this will bring any value to the table?
Yes, clearly, the liquidity benefit of this, I believe that the payment will be, because it's not an equity swap, so it's going to be a cash consideration. So that will go a long way to support the operating cash needs of FBN Holding, particularly First Bank. And that will go a long way for them to optimize value in terms of the benefit of deploying that additional cash in their lending or fund-based activities. But the core of the issues we take away from this is that it looks like merchant banking in Nigeria is challenged. Like you rightly pointed out, some of the big commercial banks today we are used to be merchant banks. Stanbic IBTC was a merchant bank. FCMB was a merchant bank. So you have several of them that had to convert to retail banking. And I think with the sale of FBN Quest, which is one of the oldest surviving merchant bank in the country, to a new shareholder, it puts a question mark on the viability of merchant banking in Nigeria, given the structure of our economic environment.
Okay, let's get away out of the street for just a moment and step into the hot waters of Nigeria's petroleum industry. I'm sure those of you on Market Street are watching very keenly the whole intrigues around the Dangote Refinery, petrol production, the pricing and so on, the NNPC, the tussle. What do you make of all of that? Because we've got a couple of oil companies listed on the market, both on the NGX and the OTC NESD.
Well, Boston is interesting because we are seeing a lot of information we really don't know what to hold on to. But what I would say is that because I don't have the details of the intrigue between NNPC and Dangote Refinery, a lot of things are coming in piecemeal, and I think there is clearly some level of media war that is going on. Because if you look at the information coming from Dangote Refinery, some of them are things that they should be able to discuss with their partners and not throw it to the public. For instance, the issue of deployment of NNPC personnel in Dangote Refinery, I don't think it's something the public is interested in. I don't think the issues around the pricing are things, these are the things that the negotiating teams should be able to resolve. But most importantly, we look at the macroeconomic impact of Dangote Refinery on the economy. Clearly, if we get it right with the pricing mechanism and Dangote Refinery products are priced at market competitive rates, the economy will be better off for it. And I think that's what we should all focus on. How do we arrive, or how do we get NNPC and Dangote Refinery to arrive and at market competitive rates so that Dangote Refinery, it becomes a win-win situation. Dangote Refinery makes reasonable profit from their investment, while as the society also gets cheaper products from a refinery situated within the country. And now that we have a refinery operating within our country and is refining products, we should expect that we get the benefit of a lower cost. But that will also commonly come if they're able to agree on market competitive pricing for a product that will come from Dangote Refinery. Remember, the Nigerian downstream sector, particularly PMS or premium motor spirit, is not fully deregulated. So if it's not fully deregulated, there has to be the major off-taker who absorbs any subsidy. And that major off-taker should be able to buy from Dangote Refinery at a price that is comparable to the price of any refinery in the world.
Johnson Chukwu, if you are Mr. President, would you just advise, call Aliko Dangote, call Mele Kyari, and call the Securities and Exchange Commission and the NGX into the room and say, look, two of you, could you just walk to the Nigerian Stock Exchange or NGX and just go listing and just resolve all this problem and let's move on? How would you say? How would you respond?
Well, Boston, it won't be as simple as that. The first thing I would do if I was the president
maybe we just make it very simple.
NNPC.
Maybe we should just make it very simple. Because now we're looking at it. We talked about privatizing the refineries. We're losing money. We're losing a lot of things. Then Dangote Refinery is here. 20 billion. If you bring 20 billion Dangote Refinery and you bring NNPC to the market, I'm sure you'll be smiling more than this. Maybe you wouldn't even have time for TV interview because you'll be making so much money. All of you as market professionals. Yeah, yes or no?
Yes, but remember that Dangote had said that they will list Dangote Refinery. I think in the next 1 year or so, in a short while, they have actually indicated they are willing to come to the market to list. But I want to believe that they also have to prepare for listing. There are a lot of post-listing requirements they need to meet. Already they have been experienced as a corporate entity in operating the market. Dangote Cement is listed. I don't think Dangote Food or Sugar is listed. So meeting the pre and post listing requirement will not be a challenge to them. But I think the issue is beyond just getting to get listed. We need to resolve the issue of pricing of their product if NNPC has to be the off-taker of those products. Unless we achieve full deregulation, which is a tough call given the cost of living crisis we are facing today. If we are in the market that is fully deregulated, like the AGO market, this discussion won't be taking place. But because our PMS market is still regulated, we still have some element of subsidy. So the question becomes, at what rate should they buy from Dangote Refinery, given that they are also required to supply Dangote Refinery crude? And I have said in different fora that the core of our problem is that we need to improve crude production so that whatever is given to Dangote Refinery does not impact negatively on what we export to earn foreign exchange. And once we achieve an increase in crude production to the extent that we can give Dangote Refinery 650,000 barrels a day, while we're still exporting about 1.4, 1.5, 1.8 million barrels a day, this economy will just be fine, and we will earn enough foreign exchange to stabilize the currency and obviously drive down the pump price of fuel, because exchange is a major component of determinant of the pump price of fuel.
You know, I'm not expected to make an opinion, but I'll tell you, if I have my way, I'll call Aliko and get Mele Kyari into the room and ask two of them to go to the market. I believe the market has what it takes to discipline everybody and make sure and take this whole conversation out of the petro-politics of Nigeria. But let's move on. I asked about those listed oil stocks, Owando, Eternal Oil, and others, and Aradel Holdings and what have you, NIPCO. So how should investors weigh on the entire petroleum sector situation right now? Is it positive or negative for those stocks? How should I trade?
I would tell you in a single word, it's uncertain. Why do I say uncertain? Because right now, these companies that particularly those in the downstream sector are consumer goods businesses. Their business thrives on volume, low margin, high volume. But interestingly, that's not what we're dealing with today. We've seen an inconsistent pattern in the volume. because there is disruption in supply, so they are not able to sustain their volume of trade. But unfortunately, unfortunately for the economy, that disruption in supply is compensated by an increase in margin. So their business has become a margin business instead of a volume business. And that's why I say there's some level of uncertainty. The answer is simply the market, the outlook is uncertain. We need to be able to confirm whether we're going to have a well-balanced market where volumes are available, and then the marketers or your marketing companies go back to earning income based on their volume traded, which is low margin, high volume. But like I said, that's not what we have today. If the disruptions continue, you wouldn't know the direction of performance of these companies, because remember that allocation is largely coming from NNPC. So it depends on what volume of allocation gets to you, and when they get to you, what kind of margin you are getting. And the margins are abnormal because of the scarcity. So the key thing is that we must normalize supply and then have enough supply to meet local demand, and then that will drive down margin, and then these businesses will achieve performances based on their distribution outlets, and the volumes are able to sell from their distribution outlets.
Okay, let's begin to sum up very quickly. I'm sure you keep an eye on the fixed income market. Stop rates on central bank treasury auctions been slowing down week on week. What do you think the central bank is hinting at? Is an interest rate cut around the corner?
Well, I think what the central bank is trying to do is reduce the cost of borrowing to private sector investors. I don't think the central bank is likely going to cut interest rate at the next NPC meeting because, of course, we know there's still so much pressure on the FX market. Remember, central bank is trying to stabilize multiple market prices. You have the inflation rate, which is the consumer price index. You have the exchange rate. You have the interest rate. These are three components of market price management that the central bank is battling with. Today, we have so much pressure on the FX market, so central bank is not likely to cut back on interest rates, at least at the monetary policy level. But I think what they're doing is reduce the amount they're borrowing from the government, from the market. Remember today, as at end of last week, central bank had borrowed over 22 trillion naira from the market. The federal government has borrowed over 22 trillion naira, 10.7 trillion naira by way of treasury-based auction, about 7.4 trillion naira by way of debt auction, DMO debt auctions, OMO auctions, and about 4 trillion naira from DMO debt auctions. So between T-bills and OMO, central bank had borrowed about 18 trillion naira. So central bank has to slow down now because that is stifling a level of liquidity available to the banks, it's stifling level of liquidity available to businesses. And today, if you walk to a banking hall to borrow money, they are offering you in the region of 30-35% interest rate. There is no economy, there's no sector productive activity that survive at 35% interest rate. So I think central bank has recognized that, and they're trying to pull back at the rate at which they are borrowing and the pricing of those borrowings so as to reverse the current high interest rate environment available or funding rates available to private sector investors. All
right, we've got just about a week to wait to see that, September 24. Thank you so much, Johnson Chukwu, the Group CEO at Carry Asset Management. Thank you as always for those insights on the Nigerian market. We appreciate that. Have enjoyed the rest of your weekend.